Remember that whole market meltdown back in 2018? Turns out I wasn't the only one who got burned. Plenty of traders, even some big hedge funds, got caught chasing that easy money dream with those volatility trades. We thought we were onto something betting against market swings, and yeah, for a while, it was like shooting fish in a barrel. Then suddenly, bam, the whole strategy exploded in our faces. Now history might be repeating itself, only this time the stakes are way higher. Here's why I'm sweating bullets. It seems like everyone's jumping on a similar get-rich-quick scheme in the stock market today. The idea sounds deceptively simple. Sell a boatload of options, collect those sweet premiums, repeat. The catch: these options are designed to tank if the market gets even a little jittery. Think of them as ticking time bombs, except instead of one ticking bomb in your basement, there are thousands spread across Wall Street, and nobody knows exactly how many are about to detonate. You might think so, what someone else is taking the risk, right? Wrong. This reckless gambling messes with the whole system. When so much money bets against market swings, it artificially calms things down. The stock market turns into a wading pool. Looks safe until that hidden riptide yanks you under. You could get sucked into the chaos even if you're not playing the options game yourself. And here's the scariest part. This time, the potential fallout is huge. Remember that 2018 volatility meltdown? Well, the risky bets fueling it were a fraction of what's floating around today. The sheer amount of money in this new scheme makes it a recipe for disaster. Even the smart folks on Wall Street are starting to panic, which is usually a sign the party's about to end and end badly. So, the question is, are you willing to bet your life savings on this rigged casino? Imagine a game of Jenga, that classic tower-building challenge. You carefully stack wooden blocks each move, adding a touch of suspense. But what if instead of solid wood you were using sugar cubes? A gentle breeze wouldn't topple your creation. This, in essence, is the danger lurking behind the recent surge in zero-day options trading in the stock market as of 2024. These options contracts with names like they came straight out of a sci-fi movie have an expiry date that coincides with the day they're purchased. Sounds convenient, right? No long-term commitment, just a quick in-and-out trade. However, this seemingly reduced risk comes at a hidden cost. Here's the rub. To make any meaningful profit from these zero-day options, traders need to place a massive volume of bets. They're essentially flooding the market with these sugar cube-like contracts, each one adding to the precariousness of the entire structure. Remember the saying, there's no such thing as a free lunch. In the world of finance, this translates to low perceived risk, often hides a much bigger potential downside. Think of the current market obsession with zero-day options as a new viral dance craze. Everyone's jumping in, from seasoned professionals to your neighbor down the street who just downloaded a trading app. This surge in popularity creates a dangerous feedback loop. Here's how it works. As more people buy these options, expecting the market to remain calm, they unwittingly push up stock prices. This creates the illusion that the strategy is working flawlessly, encouraging even more people to join the frenzy. It's like everyone piling onto a crowded life raft, convinced it can hold the entire ship's crew. But just like that overloaded life raft, the whole system risks capsizing when the market inevitably encounters rough waters. The real danger lies in the way these zero-day options are structured. Remember, those buying these contracts are essentially betting that the market will remain stable until the end of the day. But what happens if instead of a gentle breeze, a sudden gust of volatility sweeps through the market? Here's where the sugar cube analogy comes back into play. Unlike traditional options contracts, zero-day options lack the time buffer to weather unexpected turbulence. If the market dips unexpectedly, these flimsy contracts could lose value, rapidly leaving investors holding the bag, or in this case, a pile of worthless sugar cubes. The potential fallout is particularly concerning given the sheer volume of zero-day options currently swirling around the market. A 2024 study by the Financial Industry Regulatory Authority, FINRA, found that the notional value of these contracts has skyrocketed to over $10 trillion, a tenfold increase from just 2 years ago. This massive pool of sugar cubes, precariously stacked on the Jenga tower of the market, represents a ticking time bomb waiting to explode. While zero-day options might seem like a tempting shortcut to riches, the hidden risks far outweigh any potential gains. Don't get swept up in the herd mentality and become another casualty in this dangerous new market trend. Remember, in the world of finance, slow and steady often wins the race. It's better to build a solid investment portfolio brick by brick using well-established strategies than to gamble on a sugar cube tower that could crumble at any moment. Picture this. You're holding a yard sale. You've got some old junk sitting in the garage. Those faded t-shirts, chipped mugs, and dusty board games nobody plays anymore. You're hoping to snag at least a few bucks for each item and make some extra cash. However, imagine a strange rule forced you to accept every offer made no matter how ridiculous. Now someone walks up and offers you a nickel for that slightly warped Monopoly board. You're hesitant, but the rules are the rules, so you reluctantly agree. To protect yourself from losing too much, you head out to the store and buy a brand new Monopoly game for full price. Seems bizarre, right? Well, this is essentially what's happening with these zero-day options in the stock market. In the stock market, there are folks called market makers. Their job is like running that yard sale. They provide the space for buyers and sellers to come together, ensuring there's always someone willing to take the other side of a trade. But just like you agreed to accept that ridiculously low monopoly offer, market makers have to step in when nobody else is willing to buy these flimsy zero-day options. Here's the problem. Market makers aren't in the business of wild gambles. They want to make money by facilitating trades, not risking their necks on a stock's unpredictable movements. So how do they protect themselves? They use the equivalent of buying a new monopoly set. They hedge their risk by buying shares of the underlying stock. This mass buying of shares by market makers acts like a hidden force, artificially propping up stock prices. Think of it like a helium balloon tied to a slightly deflated beach ball. The added boost from the helium creates an illusion of buoyancy, even though the beach ball itself isn't that valuable. Here's where things get risky. If a lot of those zero-day options start tanking, which they're designed to do in volatile markets, market makers might suddenly have to dump those stocks they bought for protection. This can trigger a chain reaction, causing a sharp drop in prices that could ripple across the entire market. Think of the stock market as a vast, interconnected ecosystem. Even if you're investing in traditional stocks and bonds for the long haul, these inflated prices could create a dangerous illusion of stability. It's like building a sandcastle on a beach with abnormally calm tides. Everything seems fine until that wave of reality washes over and demolishes your hard work. Picture this. It's wildfire season in California. A small fire breaks out in a dry canyon. No big deal, right? Firefighters can easily contain a blaze that size. But what if hidden from view someone had been dousing the surrounding hillsides with gasoline for months? Suddenly that small fire isn't so small anymore. That's the potential danger with this explosion of options selling strategies as of 2024. Back in 2018, a similar reckless bet on calm markets caused a market meltdown known as volmageddon. Investors lost billions and some high-flying hedge funds collapsed entirely. Fast forward to 2024 and the numbers are staggering. Instead of $3 billion sloshing around, we're now looking at over $63 billion poured into similar strategies. It's the financial equivalent of stockpiling enough gasoline to turn an entire forest into an inferno. Imagine if even a small percentage of those bets go bad. Remember, market makers who reluctantly bought these risky options have to protect themselves with stabilizing purchases of the underlying stock. Recent reports by the Bank of International Settlements, the central bank for central banks, show that volatility in the stock market is being artificially suppressed as of 2024. This creates a false sense of security, luring even more investors into these risky options plays, adding even more fuel to the fire. Now, I'm not saying there's a conspiracy. It's more like a ton of money rushing into a strategy that looks safe, artificially suppresses volatility. The market gets unnaturally calm. This works great until it spectacularly doesn't. Think of it like a beach ball held underwater. Eventually, it's going to explode upwards. Lots of this money is flowing through ETFs, meaning regular folks who don't understand the risks are pouring cash in. And here's the kicker. Even a small portion of this $63 billion being unhedged could trigger a catastrophic chain reaction. The thing is, those big Wall Street players aren't dumb. They're starting to bet the other way just as retail traders are going all in. This is exactly the kind of setup that could spark a flash crash, sending the market into a tailspin. If you can't explain a strategy to your grandma, don't invest in it. These get-rich-quick schemes always prey on the allure of easy money. Don't gamble what you can't lose. Any trade where you could lose big and only win small is a recipe for disaster, no matter how smart you think you are. If you're convinced a market is broken, and let's face it, this one is, you need to bet small and patiently. It's not about being right, it's about surviving long enough to win big when the crash finally happens.